Good morning, this is TOITOI Japan Market Radio for Wednesday, April 8, 2026. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japan exposure, whether you're managing portfolios with Japanese equities, monitoring yen positioning, or keeping an eye on Bank of Japan policy. Today we're seeing some dramatic moves across Japanese markets following major geopolitical developments overnight.
Thanks for having me. Yes, it's been quite a session. We're looking at a broad risk-on rally across Japanese assets this morning, driven primarily by news of a ceasefire agreement between the United States and Iran. Japanese equities have surged sharply, the Nikkei and TOPIX both rallied over 5%, while the yen has strengthened approximately 1% against the dollar as safe haven flows begin to reverse. We're also seeing some modest movement in JGB yields as investors rotate out of defensive positions.
Let's dive straight into the main catalyst here. The headline making waves is that the United States and Iran have agreed to a ceasefire, and this has triggered a significant rally not just in Japan but globally. Wall Street futures were up as much as 3.4% overnight, and Asian markets have followed suit. Can you walk us through what actually happened and why this matters so much for Japan specifically?
Absolutely. The ceasefire agreement represents a major de-escalation of geopolitical tensions in the Middle East, which had been building for some time. For Japan, this matters on multiple levels. First and foremost is energy security. Japan imports roughly 80% of its oil, with a substantial portion coming from the Middle East, so any reduction in supply disruption risk directly impacts energy costs and economic stability. Second, this shifts the global risk environment. When geopolitical tensions ease, we typically see capital rotate away from safe haven assets like yen and Japanese government bonds toward riskier assets, particularly equities. And third, improved global risk sentiment tends to support demand for Japanese exports, especially in cyclical sectors like autos, semiconductors, and industrial machinery.
So the 5% rally we're seeing in the Nikkei and TOPIX today, that's really a reflection of this risk-on sentiment taking hold?
Precisely. The magnitude of the move tells you how much geopolitical risk premium had been embedded in Japanese equity valuations. When that premium gets removed suddenly, you get this kind of sharp revaluation. The sectors leading the rally are exactly what you'd expect in this environment: exporters, cyclicals, and companies with significant exposure to energy costs. Auto manufacturers, electronics companies, and industrial machinery producers are all benefiting from both the improved risk appetite and the prospect of more stable energy input costs. However, it's worth noting that institutional investors are also thinking about how sustainable this rally might be, which brings us to the yen dynamics.
Yes, let's talk about the yen. We mentioned it strengthened about 1% against the dollar. That might seem counterintuitive in a risk-on environment where typically we'd expect safe haven currencies to weaken. What's your read on the yen move here?
That's a great question, and there are two forces at work. Initially, we saw some yen strength as the news broke, which reflects the unwinding of certain positioning and perhaps some repatriation flows. But looking forward, the more important dynamic is that as geopolitical risk recedes, the structural case for holding yen as a safe haven diminishes. That should put downward pressure on the yen over the coming sessions, meaning dollar-yen should move higher. A weaker yen would actually be supportive for Japanese exporters from a competitiveness standpoint, though it does increase import costs, particularly for energy. So there's a bit of a balancing act here. The key for global investors is to watch whether this 1% move is just an initial reaction or the start of a more sustained trend.
Staying with the currency theme for a moment, how are you thinking about positioning in dollar-yen given this development?
From a portfolio management perspective, the ceasefire reduces one of the key tail risks that had been supporting yen safe haven demand. If global risk sentiment continues to improve, we should see further unwinding of defensive yen positions. That argues for dollar-yen moving higher, which is generally positive for Japanese exporters' earnings when they repatriate overseas revenues. However, investors also need to keep an eye on the Bank of Japan's forward guidance. If the BOJ perceives that global stability reduces the need for extreme accommodation, that could shift rate expectations and complicate the currency picture. For now, though, the path of least resistance for dollar-yen is probably higher.
On the policy side, you mentioned the Bank of Japan. How does this geopolitical shift affect the BOJ's calculus, particularly around yield curve control and the broader normalization path?
This is crucial for bond investors. The immediate impact is that as risk on sentiment takes hold, we're seeing modest upward pressure on JGB yields. Investors are rotating out of defensive fixed income into equities, which means the safe haven bid for Japanese government bonds is easing. From the BOJ's perspective, reduced geopolitical risk and improved global growth prospects could reinforce their view that gradual normalization is appropriate. However, they're likely to remain very cautious and data-dependent. The key will be whether this shift in global risk appetite translates into sustained domestic demand and inflation in Japan. If energy costs stabilize or even decline due to improved Middle East stability, that could actually complicate the inflation outlook, which might keep the BOJ cautious about tightening too aggressively.
Shifting back to equities for a moment, we've seen the Nikkei and TOPIX both up over 5%, but also the Kospi in South Korea had similar gains. Is this a Japan story specifically, or is it more of a broad Asian risk-on rally?
It's definitely a regional story, but with some Japan-specific angles. The broad move across Asian markets reflects the global nature of the geopolitical relief. When tensions in the Middle East ease, it benefits all Asian economies that depend on energy imports and global trade. However, Japan's move is particularly pronounced because of the combination of factors we've discussed: the energy security angle, the yen dynamics, and the composition of the Japanese equity market with its heavy weighting toward exporters and cyclicals. Korean markets are rallying for similar reasons, especially given their own semiconductor and auto exposure. But for global investors allocating to Asia, the key takeaway is that this isn't just a single country bounce. It's a risk premium re-rating across the region.
Looking at the details, you mentioned that cyclical and export-oriented sectors are leading. Are there any particular industries within the Japanese market that you think are especially well-positioned coming out of this news?
Several sectors stand out. Auto manufacturers are obvious beneficiaries. They benefit from improved global demand sentiment, more stable energy costs, and if the yen weakens further, better export competitiveness. Semiconductor and electronics companies are another group to watch, especially given their sensitivity to global tech cycles and supply chain stability. Industrial machinery and capital goods producers also tend to do well when global risk appetite improves, as that typically signals better capex spending ahead. On the flip side, defensive sectors and utilities may underperform in this environment as investors rotate toward more cyclical exposure. The right sector could also see some pressure if JGB yields continue to drift higher, as that affects relative valuation dynamics.
Meanwhile, looking at the global context, Wall Street futures were up significantly overnight, 3.4% at one point. How much of today's Japanese market move is really about Japan versus just following the global risk on tide?
That's an important distinction. I'd say the move is probably 60% global beta and 40% Japan-specific factors. The global risk on sentiment is absolutely the primary driver. You can see that in the synchronized moves across equity markets worldwide. But the Japan-specific component shouldn't be discounted. The energy security angle, the particular sensitivity of Japanese exporters to yen levels, and the positioning of global investors who may have been underweight Japan due to geopolitical concerns all add incremental momentum. For global investors, the question is whether this creates a sustainable entry point or whether it's just a relief rally that will fade once the initial euphoria passes.
That's a good segue to thinking about durability. How sustainable do you think this rally is? Are there risks that could reverse this positive sentiment relatively quickly?
Sustainability depends on a few factors. First, does the ceasefire hold and lead to broader regional stability, or is this just a temporary pause? Second, how do energy markets respond? If we see a sustained decline in oil prices due to reduced supply risk, that's structurally positive for Japan, but it also complicates the inflation outlook. Third, what happens with global yields? If the rally in risk assets pushes U.S. Treasury yields and other global rates significantly higher, that could eventually weigh on equity valuations, including in Japan. And finally, we need to watch the yen carefully. If yen weakness accelerates too much, that could reignite concerns about import cost inflation, which might force the BOJ's hand on policy. So there are definitely cross currents to monitor.
As we wrap up today's discussion, what are the key takeaways for global investors monitoring Japan exposure right now?